Welcome to It's the Economy. We often hear politicians praise India's economic growth to the skies. But when it comes from a seasoned blue-blooded economist like Chetan Ahya from Morgan Stanley, we have to take the compliments seriously. And that's why I have with us the man himself, Chetan Ahya, Chief Asia Economist at Morgan Stanley. Chetan, good morning. Thank you. Welcome to the show. Let me start with a quote from your report, your latest report. I quote, "India's economy is going from strength to strength. We think India is benefiting from a combination of cyclical and structural tailwinds. In recent months, a wide variety of indicators suggest that India's recovery is strong and broad-based and is well-placed to sustain growth rates of above 6%, end of quote." Okay, Chetan, at least tell us what is most impressive about the growth story.
Lata, I think, as I mentioned in the note, it's broad-based. But the two numbers that really stand out is India's manufacturing PMI is at 57, whereas global manufacturing PMI, excluding India, is in contraction mode. Similarly, India's services PMI is at 62, and rest of the world is not really seeing that kind of strength in the services sector. So I think both these numbers are really a clear standout for India. And in fact, in comparison to India's own history, the services PMI is at like a 13-year high. Manufacturing PMI is near 11-year high. And we are seeing that the story in India is working out to be quite well, not only because of the cyclical factors, but also because of the structural reforms that the government has been implementing. It's coming through together. So we are seeing strong consumption, we are seeing strong investment. So it's a story which is quite unique in this world where we are having a problem for growth across regions and across economies.
If of course you go on to a number of other factors also, like credit growth, real credit growth, and other factors, consumption, but why aren't you increasing the growth forecast from 6%? Reserve Bank is standing at 6.5%.
We are at 6.2, Lata, so it's already relatively strong. And last I had seen, we were slightly ahead of consensus. So yeah, the numbers have in the last 2-3 months definitely been stronger. So it only makes us feel more confident about our 6.2% number. Okay.
Yeah, I'm sorry. If it's 6.2, you are still an outlier. The RBI is an even bigger outlier at this stage. How much do you think the global slowdown can be a headwind? We have seen Indian goods exports fall a bit. It's 12% lower than a year ago and 12% lower than a month ago also. But April is always lower than March. But a year ago, 12% lower. Do you think there's more pressure to come on goods exports?
Well, actually, at the margin, what we are seeing is sequentially, when you look at some of the countries in the region, like Korea, China, Taiwan, exports number seem to be turning up. Now, in the context of our view, where US and Europe will probably see some more slowdown in domestic demand, we don't expect exports to turn up quite aggressively. But it does look like the worst of goods exports weakness is behind us. And, that's the reason why that's happening is the goods economy sort of operated on a different cycle where it had boomed much before services sector. And then now in the last, few months, we've seen a massive adjustment with goods demand globally. And that's also reflected in Asia's exports, India's exports. But we kind of think that cycle has already gone through adjustment and the worst is behind us. But, services exports are also exposed to global economy and US economy, and there will be some weakness there. But what we observed is that service sector exports tends to be more defensive. So if you go back in history, only in 2008, services sector exports contracted on a YOY basis. But in 2012 and 2014, when goods exports had gone through contraction, services export did not go through any contraction. And remember that services export growth in India is also driven by gain in market share. So it's not just beta of global services sector doing well, but also the market share gain, and that market share gain will be retained. So we feel that India has that advantage of being exposed to services sector alongside goods, and that will lend some defensiveness to the external demand development for India. So all what we are making in this note that you highlighted is that really domestic demand is the bigger driver, and that domestic demand is coming in both in consumption and investment, even while you have some weakness from the external side.
Do you see the Capex cycle picking? When we speak to industry, we get varied views. Everyone's in unison that the central government's Capex is excellent. State capital expenditure is the other end, not picking up at all. And corporates in between, selectively, yes, but no one's saying that the cycle is here. What do you think? That can this 6% or 6.2 grow towards 7% in coming years? Do you see that kind of a Capex cycle already?
So we see early signs of Capex picking up. So real industrial credit is picking up. At the same time, we look at capital goods imports. And real capital goods imports have been growing at a healthy rate of about 17% on a year-on-year basis, which is, by the way, again, unique. We don't have that anywhere else in the world. So there are some indicators that are showing that there is an uptick underway, and CMI's private investment projects under implementation is also growing quite nicely on a year-on-year basis. So I think the Capex cycle is underway, and it is probably aided by the government's Capex story, but definitely the private sector is also joining on. And just one additional point on the Capex story is if you look at the capacity utilization chart, which the RBI puts out, that is also indicating that capacity utilization is at a level where you would see private sector taking up some expansion in the Capex.
The only problem with that 74 number is I've been hearing it like for the past 10 years intermittently, but it's not yet fired up. But let's be more hopeful this time. But I really want your opinion about China. The latest data we are getting are a little disturbing. I mean, much of the April data, industrial production, retail sales are better than March, but way below what the market was expecting. Are you seeing some kind of a slowdown in China? And what does that mean for global commodities, for India, etc.?
So, look, there is definitely some softness in the data that we saw yesterday, but we kind of parse it in two segments. So if you look at the final demand-related indicators, which is retail sales and fixed asset investment, those did well compared to industrial production. So you had some downside in retail sales and fixed asset investment, but that was more moderate in terms of downside surprise. The real big surprise came in the industrial production. So to us, it seems like there was some probably inventory adjustment. And on the face of it, industrial production alone itself would read to be too far negative. But when you see it in the context of retail sales and fixed asset investments, it's not that bad. And in any case, we think that this is a different cycle in China. In the past, what used to happen is that the government goes ahead with a big bang public capex investment, and that would drive the recovery. But this is a different cycle where recovery is going to be driven by consumption, not investment. That consumption growth will be driven more by organic factors like labor income growth rather than fiscal stimulus or transfers. And within consumption, it is going to be services first and then goods. So if you look at the data with these three factors in mind, then we think that the recovery is not really that worrying in terms of pace that you should think about downside risk to China's growth forecast.
Okay. That's extremely helpful to understand, putting it in context. A final question to you, Chetan. A lot of demographers and economists, development economists, say India is facing a similar positive situation that China faced in the 90s when demography kicked in our favor, and now we are becoming perhaps the back office of the earth, of the world, just as China became the production hub of the world. Now, do you see enough investments coming to India from your perch? We have our PLI schemes, but so does Philippines, so does Malaysia, so does Indonesia. Do you see a sizable amount of that China plus one coming towards India? Do you see a sustained 7% plus growth for India?
So, as you know, Lata, and you had me on your show earlier talking about our India Blue Paper, and we are precisely making that call that we think that there will be a lot of attention that India will get from multinationals, and India will become an important source for global manufacturing. And we are forecasting 6.5% GDP growth, not quite 7 as you were asking. But I think 6.5% on this large a size or base of the economy is still pretty strong. And we're expecting that India will be able to become the third largest economy from the fifth largest economy that it is right now in the next 3 years. And so I think that whole presence that India will get once it's becoming this large as third largest economy in the world, it is going to get attention of a lot of multinationals as a base for manufacturing, but also as a market. In terms of the delta in nominal dollar GDP, India will be throwing something like $500 billion of new GDP every year. And that would be the market opportunity for the multinationals to capture in India. And you are seeing interest in our survey that we are doing, not survey, but machine language learning project that we do on the quarterly results of the multinationals, which Rhythm runs it every quarter. That multinational sentiment index for India is gone to a new level. And so that's telling us that there is enough interest from multinationals in India to outsource and also as a marketplace.
Okay, that's a huge one you're giving us. And while we have discussed your blue paper, I think we need to speak about this a little more. Thank you very much, Chetan Ahya, for joining us with your views on China, India, and the way the future looks to you. At the moment, the markets are not grasping so much of the great India story, a little bit in the red because of headwinds from the US debt ceiling, probably. We'll wrap up on Bazaar on that note, and Chartbusters will take the action.